The one thing I would just like to share with you a little bit, and this is more of a strategy, but does everybody know what an HSA is? Not really? All right, well, let me give you a little overview, just a simple overview of what it is. An HSA stands for a health savings account. That's what it stands for. And what this health savings account does, it's tied to what's known as tax-qualified, large deductible health insurance plans. So you might have a health insurance plan right now where if you go to the doctor, you're paying a copay, okay? Or if you go get your prescription drugs, you pay a copay. You know, and you might have out-of-network benefits. You know, if you go in-network, you pay a copay. If you go out-of-network, you're going to be subject to maybe a deductible and co-insurance. One of the type of programs that you might want to look at for yourself is the strategy of looking at a tax-qualified, high-deductible health plan. Because if you take a look at the premium that you're paying on your, I'm going to call it traditional health plan, you might be paying $650 a month for a single rate, roughly. If you took a look at a tax-qualified high-deductible plan, maybe a plan with a $3,000 deductible, which is kind of high, your premium for that type of program might run $350 a month. So if you take a look at the difference in premium, you're looking at $650 minus $350, that's about $300 a month. $300 a month times 12 is about $3,600. You're allowed to take $3,000 and actually open up a personal bank account. And that personal bank account is called a health savings account. And the idea is that you're going to use that account rather than going to the doctor and paying co-pays like you were before. Essentially, you're going to be using that bank account to pay for your incurred costs. And what's going to happen, or what you will notice if you decide to use this type of strategy, is that when you go to the doctor, typically you're not going to pay anything under an HSA. And then you're going to get what's known as an EOB, explanation of benefits from the insurance carrier. You're going to pay the doctor or provider the negotiated rate that the insurance carrier negotiated with the provider. So if the doctor normally charged $100, and if you go in network and you buy this tax-qualified high-deductible plan, and then negotiated rate is, say, $50, that's how much you would pay the particular provider from your HSA account. And again, that HSA account is tax-deductible for you. And if it's used for unreimbursed medical expenses, you know, Section 213 comes out tax-free. And essentially, if you don't use it, it kind of accumulates like an IRA until you're 65 years old. So if you're already maxing out on your pension plan, not that we're here to talk about pension plans, here's another way where you could put some dough away, get a personal tax deduction. If you use it for your unreimbursed medical expenses, that's fine, that's what it's there for. But if not, it's going to accumulate until you're 65 years old, and then you can take a distribution similar to an IRA at that time. So it might be a strategy that you might want to look at for yourself personally or for your business to see if it makes sense. And you just want to do the math. If you go to the doctors a lot, you know, depending upon what the difference is on premium, maybe it won't. But if you don't go to the doctors a lot and the difference in premium is there, maybe it will. So it's just something that you want to take a look at. But that's what the HSA is, a health savings account tied to from an insurance carrier purchasing a tax-qualified high-deductible plan.
Just curious, is the flexible spending plan the same as?
No, the flexible spending plan is a little bit different.
How are they impacted?
Typically under a flexible spending account, you might have a regular co-pay type plan where if you go to the doctor, you'll pay $25 or $50, and if you go have a hospitalization stay, maybe there's a $500 copay. But under an FSA, what you're allowed to do on a pre-tax basis, you could elect to put away money into an account that can be used, again, to reimburse. But the difference is, under an FSA, everybody's heard that term, you need to use it or you're going to lose it. You know, that's the issue that you have with an FSA, that if you don't spend that money at the end of the year, you're going to lose it. So you have to be very careful on how much you elect to put away under an FSA. And again, under the FSA and the HSA, over-the-counter drugs, you know, your Advils or your aspirins, are not going to be covered anymore. You can't take that, you take the money out of the accounts for that. You got to go to the doctor and get a prescription. That's how it's got to be covered. And again, Yeah, that's basically
Well, you know, I think one of the things that should be mentioned, and I don't know how, you know, many of your businesses are structured, the HSA versus the FSA, partners in partnerships cannot utilize a flexible spending account. However, they can participate in a health savings account. I can tell you in my company structure, we just changed last year to a high deductible HSA. Our partners couldn't use a flexible spending account, and this was essentially, and they were raising our rates 20%.
Yeah, I see what I'm saying.
And so in lieu of that, we lowered our premiums. Our partners were distributed dollars to go into an HSA, and it's actually, you know, if you're not spending it, it works great.
Agreed. And the one point that I would like to share is Arnold is from an accounting firm. And if the accounting firm did the math and it makes sense for them, maybe you just want to take a look at it for yourself. But
And also,
I can answer your second question about the high deductible plan. Basically, when you purchase a high deductible plan, as an employer, you know, there's a couple of options that you have available to you. If you buy a high deductible plan, you could either pass some, a portion, or all of the deductible onto the employee. All right, but typically what that has to do with is where you're currently at today, your current contribution strategies. In other words, how much is the employer paying for the coverage? How much is the employee paying for the coverage? So those types of factors are usually used in determining whether the employer is going to contribute into an HSA plan or not. Okay, that's number one. Now the employer can establish, you know, with a financial firm, a group accountant, send the money in on a monthly basis, a health savings account. But the one thing that I did want to share with you, which we really didn't go over too much today, is there's also another type of an arrangement. It's called a health reimbursement arrangement. And I like these plans personally myself for employers that have, you know, 7, 8, 25 employees. Or if it's a 1 or 2 person group, maybe they're better off with an HSA. But as the more employees you have, the more applicable this particular strategy is. And the reason I say that is because personally, I'm cheap. I don't like to spend money when I don't have to. And I feel most employers probably feel the same way. So what we can do is under a health reimbursement account, we can go to the employee and say, listen, if you incur claims up to the deductible or up to a specific amount, and we could arbitrarily choose what that amount will be on a contract year basis, we'll reimburse you for those incurred claims. What that does is rather than me as an employer actually taking money and putting it in an actual account for the employee where he might not even be using healthcare services, it minimizes my exposure because I'm only going to pay if the services are used. So in a way, it helps reduce what my employer expense may be. Now, me being the employer, I might not be eligible, and I'd have to speak with my accountant about this. I might not be eligible for a health reimbursement arrangement. I might personally have to set up an HSA, but that's a way that the employer could actually reduce their costs and not have to actually give away the dough that ultimately might not be used.